Welcome to Medical Economics Pulse. I'm your host, Chris Mazzolini. We are seeing a lot of volatility in the stock market recently. The S&P is down almost 20% from the top, and some are calling it a bear market. Many physicians are obviously concerned about their portfolio and a further market downturn. So what should be your investment strategy during a market decline? To discuss this topic, we have Syed Nishat with us today. Syed is a partner at the Wall Street Alliance Group and is a regular contributor to Medical Economics. He is regularly quoted and interviewed in media outlets such as Forbes, Kevin MD, US News, Yahoo Finance, and many more. He can be reached at www.wallstreetag.com. Without further ado, Syed Nishat. Syed Nishat, thanks so much for joining us today.
Thank you, Chris, for having me again.
So Syed, your firm, Wall Street Alliance Group, specializes in financial planning for physicians. So what are you hearing from your physician clients, and how is their reaction to the market turmoil we've been seeing here in 2022?
Yeah, so Chris, obviously for the last few weeks, we see a lot of market turmoil, ups and downs in the market. And I was talking to a few of my clients, and actually I was calling them to congratulate their kids who are actually our residents, and they actually got a match in the match day. And then I got a call from a new client, and he sounded very nervous, and he said that he was reading a lot of articles, and he believed that the market is heading for a 70% correction. And he's pretty convinced, so he thinks the best thing would be to sell everything, whatever in the portfolio, wait for a year, and when we see the market bottom, we just buy it back. It's been 17 years, 18 years I've been doing it, and we are managing about 400 million assets under management. And this kind of knee-jerk reaction, emotion roller coaster, we see it all the time. And Chris, we are, trying to explain to all the clients the same, I think, explanation. You hear it a million times, and we call it a boring conversation. And we need to have the boring conversation back to our client that investment is a long term. It's not something called short term. And investors are quite used to seeing that market going up every year. Last 3 years, market goes up 10%, 20% is an anomaly. So market must go through a correction. So if you cannot see a correction, you're not an investor. So that's why it's very important to have a long-term approach. And we have to see the facts. And the fact, Chris, is since 1947 until last year end, S&P went down 14 times, more than 20% in bear market territory, what we call it. And each time market fell for different reasons, like dot-com bubble or housing market bubble, you name it. One thing common in each catalyst, that in subsequent year, S&P not only recovered, but it actually had a double-digit return. So the key message is short-term market is always could be volatile for different reasons, but long-term, historically, market has always gone back up.
So let's set the stage a little bit about this market volatility. What do you see as the main reason for why we're experiencing this in the market this year?
Yes, Chris, I think the trillion-dollar question right now, whether we're going to go through a recession or not, that's what everyone is talking about. But the investor has to take a step back and understand that what are we talking about? What is a recession? And are we going to go through a recession or not? But first thing first, the main reason why people are talking about recession is because Fed is increasing their interest rate. I mean, obviously, that's what everyone is saying. Fed won't be able to control it. But we have to keep in mind that my client recently bought a house in Orlando, Florida. In 1 year, the price jumped 20% in housing in Florida. I don't know where you look at it, but in New York, in suburb, I want to buy a place, there's a 5 bidder out there. So these are definitely market is overheating. And what Fed is trying to do is trying to calm the market down. And so that's what Fed does. They increase the rate. The problem with raising the rate, short term, it can cause inflation. And the result of inflation, that means Fed is trying to cool off the economy, that call a recession. That's what he's saying. Now, there are two chain of thought in the market. Some people are saying it's going to be short term, soft landing. Some people are saying it is going to be a long-term recession. And market will go down a lot. We at Wall Street Alliance Group believe that Fed should be able to orchestrate this whole inflation issue very smoothly, is because if you take a look at the GDP data, our consumer spending is 70% obviously of our whole GDP data, and consumer spending is very strong. Like I was trying to go to take my children to the grandparents, airport is fully packed and people are hungry to travel. Everyone wants to travel right now because we're recovering from COVID. And if you look at the unemployment data in your article, you guys wrote about the great resignation. So it's shortage of employees are here. And that for every unemployment people, there's 2 jobs available. So we believe, the reason why we're seeing all this volatility is because of 2 factors adding fuel to the fire, which is number one, the Ukraine issue with Russia. We're seeing it, oil price went up a lot. And China, there's a zero COVID policy though. So we are seeing a disruption in the supply chain as well. So I think once these 2 things are settled down, we believe that we see a small indication that recession is in control because the market is forward looking, keep in mind. And a market is trying to price it, what's going to happen if inflation happen, if a recession happen. And that's why most of the things is computer driven. And that's why pricing of the market is really complicated. And that's why we're seeing the volatility. But any good news comes in, the recession is in control, we should see a V-shaped recovery in the market.
Okay, great. Thanks for that. In terms of investment strategies right now, what are the planning and investment strategies in this market that you recommend to physician clients?
Yeah, Chris, so rather, trying to be panic about the market and, trying to analyze, there's a lot of strategies investment can use because we see that obviously S&P is down from the top about 20%. It's a great time to do something called tax loss harvesting. Tax loss harvesting means that any stock which are down right now, you take a loss, but buy something similar. And if the market goes back up, your portfolio have the same exposure, but you can carry forward the loss. And this stock market loss, if you have a real estate profit gain, you can offset from there as well. So it's a good time to do a tax loss harvesting if you want to, and you can carry forward every year the tax loss, so it's a great time to do it. It's also a great time since the market is down to Roth conversion. Remember, in a pre-tax money, all the physicians are contributing, they have to pay taxes anyway after the age of 60, and taxes are going up, we all know it, but it's a good time to do Roth conversion because all the stocks are down. Let's say you have Apple, which is down 20%, convert it to a Roth IRA. The benefit, once you convert it, the money grows tax-free. Withdraw is also tax-free after the age of 60. And in your show, we spoke about Secure Act, which passed, and a lot of physicians are not paying importance in it. In Secure Act, Chris, in 10 years after husband-wife dies, the beneficiary has to use the money, which is a huge issue. So Roth conversion is extremely powerful, extremely important because the Roth IRA is also part of the Secure Act, but you don't pay any taxes when you withdraw the money. So that's why a Roth conversion is the ideal situation at this stage. Also, another thing the high net worth physician can think about is estate planning, because this is 2022. So 2025, the exemption is going to go down, it's expired. It's expiring in 2025. So far right now, up to 22 million, husband, wife both dies, there's no taxes due. But it's going to come down to 11 million. So if you're in high net worth, it's a good time to gift your stocks through an irrevocable trust because all the stocks are down. And once you gift it, the funds goes estate tax free. So extremely powerful. Think about estate tax planning right now and gifting it. And then, a lot of physicians contribute into retirement account, defined benefit plan, educational plan. This is a good time to buy it because Warren Buffett always says, be greedy when others are fearful and be fearful when others are greedy. And it's a perfect time to be greedy because market is down. So once you contribute into the IRA account, the money grows tax deferred. And you can pre-fund it. Whatever contribution is due by December, you can talk to your employer and try to bundle up together all the contribution, and hopefully you'll have a good dollar average cost. And lastly, Chris, for the last few years, one of the major challenges we see retirees, they were not actually getting yields. The interest rate goes up. The CD rates are very attractive nowadays. I was looking for a CD rate for 5 years, is about 2.5% per year though. So if you wait a little bit, if the inflation perk up, maybe it will go up to about 3%. And CD is FDIC insured up to 250,000. It's a great, I think. So again, these are, I know I spoke too quickly, but these are some of the strategies investor can sit down with their financial advisor and go over it.
Great. So let's talk about the flip side. What are the mistakes to avoid if you're an investor in this market?
Yeah, we see 3 major mistakes for the last 18 years. We've been doing it. Number one is trying to time the market, like my client at the beginning I mentioned. So timing market is very dangerous and it's very, very hard to do it. If you take a look at the statistic, Chris, for the last 20 years, S&P return until last year, the return is annualized about close to 9.5% per year. on average. Now, as an investor, if you have missed the best 20 trading days, again, you missed the best 20 trading days for the last 20 years, your return instead of 9% becomes about below 2% per year. If you miss the 40 best trading days, that means about on average 2 per year. If you miss it for some reason, your return becomes negative. So the question becomes, how do you know the best trading days? And usually the best trading days happen when the market start to go back up. So a better approach, rather than trying to time the market, sell everything, and buy it, a better approach would be average cost. When the market goes down, try to buy a little bit slowly, so you have a good average cost. Is much better approach. Second biggest mistakes we see it is over concentrated in one position. We see it like all the new clients we have acquired for the last couple of years. We see heavily concentrated into technology stock because the story was tech last year, but the issue is people put like too much into one stock. The problem is that not necessarily that those sectors will go back up if the market recovers from here. So make sure that you're properly diversified. Asset allocation is the key. You have all the sectors necessary. And lastly, I would mention that try not to use margin. It's very dangerous. Margin is like taking a loan against your account and actually buy some stock, which is, we call it a kiss of death, because you actually use double the money, plus you pay more than 4% interest. So try not to use a margin. If the account is down, don't panic sell and liquid the margin. Try to pay off the margin, hold off if the positions are good, if the accounts are diversified. In the long run, we have seen the market always recover.
In terms of creating a diversified portfolio, are there specific sectors that an investor should maybe focus on right now, given the trends?
Yeah, usually what happens that since right now the trend is interest rate is going to go up, looks like, so usually financial sector tend to do very well when the interest rate goes up. So make sure you have financial sector in the market. Also, utility sector. Everyone will be using natural gas for the time being, and then they're actually changing, to becoming more energy efficient, and they pay a huge amount of dividend as well. So try to get into those sectors as well. And also consumer staple sectors tend to do very well. Like for example, Procter & Gamble, Colgate, because people always will be toilet paper and they have the ability to pass the cost to the consumer. So Pepsi, Coca-Cola, make sure you have those sectors as well. Don't just focus on the tech sector. A diversified portfolio is the key to go. And also you can talk to your financial advisor to buy some beaten up blue chips. So make sure large cap stock is the way to go. Not like, those, a lot of people are buying like stock because due to COVID that went up a lot, but COVID we are unwinding it. So try to get into the blue chip company, which are very important.
Okay, great. One thing we always, hear from retail investors, physicians who are doing this is, between targeting individual stocks or looking at index funds. What is your recommendation for these retail investors on how they should sort of look at those different opportunities?
Yeah, it's a great question, Chris. And if you ask Warren Buffett the same question, he will say before he buying a stock, usually in a piece of paper, he write down why he buys it, right? And then based on that and buy it. But retail investors, our experience has been they buy it because their next door neighbor is buying, which are very dangerous, and they sell it the same reason, for fun or without much of a understanding why you're buying a stock. And stock inherently are fairly risky. I mean, take a look at Netflix. I'm just giving you an example. In a few weeks, it gave away all the growth happened last few years. The issue we see with investors, Chris, that they don't have the discipline to buy a small portion of the portfolio. They buy usually a lot without thinking in one allocation. And if one stock goes down, they lost tremendous amount of money. Individual index funds are a better approach, is because they pretty much mirrors what S&P is going to do, the index funds, and then the costs are very low. So in the long run, the index fund mirrors the S&P and goes up, and it's a better approach for retail investors. Try to shy away from buying individual stocks unless you are very experienced or you're using a professional financial advisor. Index funds is the way to go. And Chris, I will just conclude that, if you take a look at, like I mentioned, the last 20 years return, S&P went up about 9% per year, even the dot-com bubble, even the real estate crash, whatever you name it. But you will hear stories from investors, I have lost everything when the real estate bubble burst. But by the way, the market went up. How did you lose it? Most likely, either they bought stock a lot in one sector that went down a lot, never recovered, or they sold it when the market went down. Our experience has been it's a combination of both. So usually what happened that if you sit down with a fiduciary financial advisor, they create a plan and show you the risk of not diversifying. They show you that if the market goes down, what happened to your retirement plan. So in this way, you don't get a surprise. So a financial plan and investment goes hand to hand. That's the end result. And a lot of physicians are not focusing on financial plan. They are just investing without thinking. So I think it's a good time to sit down with your financial advisor and create a solid financial plan foundation so it can navigate through the volatility we're going through right now.
Last question, where can people learn more about the Wall Street Alliance Group?
Yeah, Wall Street Alliance Group, you can go to our website, is www.wallstreetag.com. Again, it's www.wallstreetag.com, and you can fill out the contact us, and one of the fiduciary advisors should be able to help you further.
Syed Nishat, thanks so much for joining me today. I really appreciate it.
Thank you, Chris, for having me again.